this session, the last session, which will be introduced by Bertrand Labilloy. Bertrand is the chair of CCRE and the general manager of CCR. Bertrand is a civil servant. He has been working with the Treasury. It's just before the panel. And you have been a long time at the FFSA, which is now FFA here at the international level, and now you are, of course, at the CCR. So Bertrand, thank you very much.
Thank you, Francois. Thank you, ladies and gentlemen, for giving me the opportunity to come back here at the office of the French Federation. It's a pleasure for me to be with you today at a conference which addresses a very important issue for our liberal democracies. Dealing with the menace of terrorism and assisting the victims of this tragedy is a challenge the insurance industry must meet with the help of governments, or to put it in another way, it's a challenge that governments must meet with the help of the insurance industry. But to begin with, I would like to speak to you about a paradox. There has never been so much reinsurance capacity available in the market as of today, whether traditional or alternative. Hardly a week passes by without a share repurchase program or a special dividend being announced by reinsurers. And at the same time, there are still many households or corporates that can't find affordable insurance for certain risks. And every catastrophe brings myriad victims that will receive no compensation for the damages sustained, not only in poor countries, but also in developed ones, not only for emerging risks such as terrorism, but also for hazards that our industry understands deeply, such as natural disasters. This is a real problem that should be our top priority because it's a matter of collective credibility for our industry, as well as being an important political and human issue. Many solutions have been imagined and implemented in various places around the world to tackle this issue. As we saw during the previous session, these solutions are very diverse, but they all involve customized cooperation between insurers and the state through what we call public-private partnerships. But given this, what is the added value of public reinsurers compared to direct state interventions? The 2 points I would like to highlight today is that public reinsurers are not merely an efficient tool to bridge protection gaps, but they also bring security, expertise, and flexibility to the insurance market and to the state. This is a value proposition of great importance. To illustrate this point, I would like to discuss several French examples, CCR on the one hand, and the NatCat regime and Gariat on the other. So let's begin with the first point. We all know that protection gaps arise from market failures. There are indeed cases where market supply and demand don't provide certain households or corporates with adequate and affordable insurance cover. The reason for that could be that there is a shortage in supply because of a lack of insurance capacity or a poor knowledge of the risk. But there may be also a shortage in demand because policyholders don't want or just can't afford to pay the premiums proposed by insurers. So the question is, how can public reinsurers deal with each of those three market failures? The first market failure, namely the lack of insurance capacity, is the one which comes first in mind when talking of insurance PPPs. It typically refers to risk for which a single event can cause a loss which exceeds the insurance capacity of all private insurers and reinsurers. Know that there is so much reinsurance capacity available in the market that criteria shall be seen on an individual basis and no longer on a global basis. To illustrate this point, I would say that in the current market conditions, the private reinsurance industry can afford to pay for the worst natural disaster that may occur in France. Indeed, the cost of an earthquake in Nice would be in the range of 10 to 15 billion euros, and a 100-year flood in Paris would be between 15 and 25 billion euros. So not that much, in fact. And what about terrorism? Before the WTC attacks, French insurers, like many others in the world, only relied on private reinsurance covers and did not use the capacity that the state had made available, even those which insured large buildings and large planes. Since the WTC attacks and the emergence of hyper-terrorism, things have completely changed, and insurers asked for the state support even for small risk. Today, CCR covers the Gariat pool with a priority of around 2.5 billion euros, while Gariat retention is about 500 million. Without going through the history of that regime, I would like to highlight two special features which are worth mentioning. First feature, at the beginning, the government conditioned the granting of this guarantee to all market players pooling their risk, while forcing them to show solidarity with each other before asking for the state support. It was also a way to set the priority as high as possible. Second feature, in the absence of significant claims, the priority of CCR's cover is being increased by 60 million euros every year, the idea being to force the industry to put aside the profits instead of relying only on the public guarantee. The poor knowledge of the risk is another source of uninsurability. Again, terrorism looks much more problematic in that respect than natural disasters. While CCR has developed a comprehensive model that allows for simulating the consequences of any type of meteorological scenario, we've made only a few simulations concerning terrorist attacks. For example, we've produced a detailed analysis on the consequences of a dirty bombing on La Défense business district. Those simulations, which are based on deterministic scenarios, cannot therefore be used for pricing, but only for capacity assessment. Among the various sources of protection gaps, adverse selection is the most difficult to deal with, since it requires some form of solidarity to be implemented between the policyholders or between the cedants. If not, the market equilibrium leads to a situation where people that are not concerned by the risk don't buy insurance. People that are very exposed cannot buy insurance because it's not affordable for them. And finally, only a small portion of people buy insurance. This is the reason why only 1/3 of Germans and 1/10 of Italians are covered by a Nat Cat insurance, with Italy and Germany having to compensate people directly when a huge catastrophe occurs. What about the French situation? As you know, every property insurance contract in France must, by law, cover terrorist attacks. This obligation potentially creates a protection gap for insurers that cover large risks, since their portfolio may be quite heterogeneous. To deal with that issue, those insurers which are concerned have formed a co-insurance pool called Gariat, which enforces solidarity between its members and which reinsures itself with private reinsurers and with CCR for the last and unlimited layer. That solution, which is both simple and efficient, works pretty well because the membership is limited in size and in heterogeneity. De facto, the market has not been able to agree on such a system for small and medium risk up to now. Likewise, that co-insurance pool solution would not have fit for the Nat Cat insurance due to the number of parties, the volume of claims to pay, as well as the variety of business models that exist. In that case, the solidarity between low-risk geographical zones and highly exposed ones is being enforced by CCR through its dedicated and specific reinsurance scheme. Insurers which want to benefit from CCR unlimited stop loss must cede half of their Nat Cat risk on a quota share basis and for their entire portfolio. This way, there cannot be any arbitrage opportunity, no adverse selection. And CCR implements the pooling of Nat Cat risk at the French level thanks to its 90% market share. At this stage of my speech, I hope you are convinced that public reinsurers can bridge the protection gaps, whatever the market failure that caused them. But what is their added value compared to direct state intervention? This is what we are going to see. In a nutshell, public reinsurers bring security, expertise, and flexibility to both insurers and to the state. To begin with, CCR brings security to the French state. Indeed, instead of having to pay on a regular basis for any huge catastrophe, the state shall only intervene when CCR financial resources are not enough to pay for losses, which is not supposed to occur often. To give you an idea, as of today, CCR economic capital amounts to around 6 billion euros, which allows it to pay for 30 years Nat Cat. To put it differently, since the Nat Cat regime was put in place in 1982, the government has never had to recapitalize CCR, which is quite a challenge. Obviously, that financial strength also serves the insurance industry. In this respect, the most important advantage is that the market can also rely on the availability of this unlimited capacity, whatever the reinsurance cycle is and whatever the claim history is, at a price and conditions which should remain stable in principle. At a time when reinsurance capacity exceeds the market demand by far, this certitude may be poorly valued, but let's just remember past reinsurance crises, and we would realize how critical it is to get this guarantee. For example, in the case of terrorism insurance, that guarantee ensures that there will never be any shortage in supply, even after a massive terrorist attack. To summarize, both the state and the market benefits from a system which allows for capitalizing the profits, the state because it reduces to almost nothing the probability it has to pay for catastrophes, and the market because they know that the money is available and can be used when necessary. CCR added value for insurers and for the market is also its professionalism. Indeed, it is not a market pool or an indemnity fund dedicated to one single risk, but it's a full-service reinsurer, which is licensed according to EU regulations, which operates in several business lines, and which has developed state-of-the-art modeling for some risks, as already mentioned. Again, the state is the main beneficiary of that expertise for two reasons. The first one is quite pragmatic. Unlike the government, we are able to speak on an equal footing with private professionals, therefore reducing the risk of offering naive capacity to the market. In fact, the market equally benefits from that expertise, since our services fully meet the best standards in terms of professionalism and technicity. The second reason is much more substantial. We are able to advise the government on issues such as how to organize the coverage of extreme risks, what's the potential cost of huge catastrophe in specific area, or which payoff ratio to be expected from some prevention measures. In a word, we more or less act as the risk manager of the government, and we will expand that role to public network companies as well as to local communities. Last but not least, flexibility is an important feature of public reinsurers. The market has flexibility because insurers are not obliged to reinsure with CCR and can go in and out our reinsurance schemes. It's an important feature for us because it pushes us to be as competitive as the rest of the market. The state has flexibility because it can use CCR on a case-by-case basis, on demand, to cover risks that are uninsurable for a given period of time. Clearly, this is the advantage of being a full-service reinsurer with a comprehensive activity worldwide in P&C, life and health, and specialty lines. De facto, CCR has quite often been solicited in the past. I'll just give you three examples. In the 80s, to cover medical practice insurers and allow the broad transfusion centers to continue operating during the AIDS crisis. In the 90s, to cover space insurers and allow Ariane 4 and 5 to be launched. And more recently, during the financial crisis, to cover credit insurer so that small and medium corporates could still have access to trade credit insurance. In conclusion, as we have seen, the role of public reinsurers in insurance PPPs is quite similar to the role of any reinsurer, where private reinsurers help direct insurers to cover extreme risks. Public reinsurers help the insurance market as a whole to cover uninsurable risks. Moreover, public reinsurers provide the market and the state with some additional services such as security, expertise, and flexibility. Those advantages are of a great value for terrorism insurance, which is an emerging risk and for which we must adapt the solutions currently in place. This being said, one should recognize the limits of the system I've just outlined, which could be also development opportunities for the future. First limit, and sorry if I state the obvious, but public reinsurers, like their private counterparts, can only reinsure risks that are covered by insurers. You know that in France, damages to property caused by terrorist attacks are covered by insurers, but personal injuries caused by such attacks are not. It was a decision that was confirmed last year by the government, but also by the insurance industry, which perceived compensation for personal injuries in that context to be very sensitive. Second limit, public reinsurers, like any PPPs, are pure national systems by nature. However, one can argue that there would be clear benefits to building a pan-European reinsurance PPP, because doing so would successfully leverage on the experience that exists in the various national markets. Thank you very much.